thank you, Matt, and thanks everybody for sticking around to the end tonight. I don't know what the level of sophistication on the insurance tech side generally, and in Oscar's case specifically here. So at the start, I just want to ask Mario, we'll talk about the history of Oscar in a second, but maybe you can just give the room a sense for the business today, what states you're operating in, what services you offer.
Yeah, absolutely. So about the history in a couple of minutes, okay, that's going to tell the story of what we actually do in a better way, but where we are today is we're a full-stack health insurance company. We currently only sell into the individual markets, aka the Affordable Care Act markets or Obamacare markets. We have about 135,000 members in 4 states now, New Jersey, New York, Texas, California. In those states, we are only in very select cities. We're in New York City, obviously, Long Island, New Jersey, kind of upstates area, in San Antonio and Dallas, in Texas, and Los Angeles in California. And why we are in a place like San Antonio, out of all the launch places we could go into, we can talk about later as we talk about networks and providers and so on. That translates into revenues of about 650 million or so on an annual basis. And we've raised from, obviously, Joel Cutler, the first guy who gave us money, and bought into the idea originally, but also Peter Thiel, Founders Funds, Joe Lonsdale, Google Capital's in there, Fidelity, Goldman, and so on.
Great. So you mentioned the Affordable Care Act. Why don't we rewind a couple years and talk about what that kind of was the catalyst for the business idea for you, or how, in the wake of that, you came up with the idea for Oscar?
Yeah. Business comes really from a conversation the 2 co-founders, Josh Kushner and myself, had in early 2012. My wife was going through the first pregnancy. And as anybody who's gone through that, as a husband of a wife who goes through it, of course, or directly, you kind of realize it's how complicated the healthcare system is. It does complex things, so there's no surprise that it's complex as a system. But what really pissed me off at the time was how little the insurance company seemed to care about the complexity. It sends you these confusing statements called EOBs, explanation of benefits, a few months after the fact, usually with everything is capitalized in these statements, usually a great sign that there's no layer between you and a computer, a database on the other end. You call them, yet they had no idea of how much this will cost you. My wife was on the phone, not on the phone, on an app all the time called babycenter.com, chatting with women in Alabama, debating how much the pregnancy would cost throughout the end of the year. And you couldn't really ask them about things like, what C-section rate can I expect if I meet this particular physician, or in the delivery room, the maternity wards, at the night of the delivery, and things like that. So all this information was very obviously available somewhere, which physician is how good at which condition and so on, but you certainly wouldn't get it from the insurance company. And so what we said is, if we could create an insurance company that really makes use of its own data in a way that it simplifies the experience of getting health care, not just insurance, but health care for the member, that would be a winning proposition. Now, there is a reason why insurers work the way they do, and the reason is that they don't actually sell to you or myself or any other average person on the street. They sell to HR departments. The name of the game over the past decades in US healthcare has been you essentially get insurance if you're employed somewhere, and your HR department makes a decision as to who you go with. It's a little bit, and then when you leave the employer, you have to leave your insurance company. It's a little bit like, changing hairdressers and changing from an iPhone to an Android. It's two things have nothing to do with each other, are weirdly artificially connected. And so then along came the ACA. In mid-2012, the Supreme Court reaffirmed Affordable Care Act, and for the first time created this market really overnight where we could go out as a health insurer and sell to individuals and convince them we have a good product, we'll take care of you, we can build a brand around it, we can tell people, go tell your friends, they should also sign up for Oscar, etc. And that was a big catalyst, but it was not the starting point. The starting point was really the user experience sucks. Somebody ought to do more in a system that we pay 18% GDP for in making it simple and accessible.
Now, Joel, let's rewind to that time for you. Were you thinking about, insurance before
I hate following Mario.
It's a tough act, but it's up to you.
No. No. Well, our job's pretty simple. We look for really big industries that, in this one, it's gigantic, and you pay them all sorts of money, and they're supposed to take care of you when really bad things happen, right? And it's really old, makes me look young. The industry's really old, the systems are really old, the business model's really old, and consumers aren't anymore. And it doesn't match. The business model doesn't match. The then you've got this enormous marketing cost and these enormous sales and distribution costs. So like the backdrop made all sorts of sense. It was really, and Josh Kushner deserves a gigantic amount of credit here along with Mario. These two guys really did all the smart thinking. My job is just to find sort of people that think in first principles and to give them as much money as we can as fast as we can. And that was Mario. And he said, this is really broken. You're a consumer guy, and you look at all these businesses you've invested in that are in the consumer space, and we can make this so much better from the bottom up. And we can build this and this and this and this and this and this and this. It's not we're going to borrow somebody else's balance sheet. We're not going to borrow somebody else's systems. We're going to build every system from the bottom up sooner or later, and we're going to make this experience wonderful. It's pretty easy. And at the time, we had this great guy who was an executive in residence in our shop, and he and Mario have since become good friends. He ran a good-sized health insurance business. He's now the governor of Massachusetts. But at the time, I remember Mario coming in and pitching the business with Josh, and everybody and the guy stands up in the middle and says, this is exactly what healthcare should be. This is exactly what, and the guy starts making their pitch for them. Basically kicks Mario off the slide deck and says, this is what it should be, blah, 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 blah. So that's how it sort of happened.
Now, Mario, it seems like what Jill is saying, one of the things that he really liked about Oscar was your kind of full stack approach. So, there's lots of ways you could have gone that wasn't full stack. So why don't you tell the audience a little bit about why you think that's the best way, at least in the health insurance market?
I shouldn't show you some of the slides we had in the investor presentation very early on. I think we didn't have them in anymore when we talked to Joel at General Catalyst, but in the very early design slides for Oscar, we actually said, we should be an asset-light insurance company. So originally, the idea was always we want to be on our own paper, as the industry calls it, meaning we want to have our own capital, our own balance sheet, and so on, to be able to make decisions more quickly and decide what we want to reimburse and pay for and so on. But the idea was, like you're building a software project, let's get the best APIs, let's get the best platforms to connect to and work on, etc. We thought that's how you can build an insurance company very early on. And that decidedly is not the case. And there's really two reasons for it, and we had to learn some of these over the years. Reason number one is sort of obvious. When you go and work with vendors that attach themselves to payers in the industry, whether it's a pharmacy benefits manager that negotiates drug prices for you, whether it's a network of physicians sometimes, whether it is other things like a utilization management vendor. These are the guys who sort of like use standardized metrics of medical decision making to determine whether to say yes or no to procedure requests and so on. You wouldn't expect these guys to be particularly technical. I can tell you some hilarious stories about the lack of technicality with some of these vendors. We had one vendor actually very early on. We told them beforehand. I won't tell you who it is and what they did for us at the time. They're not a vendor anymore. Been a long time. But we flew out there. It was in 2013, early 2013, and we said, bring your technology guys. We want to talk about how to tap into your systems and get real-time data exchange between your systems and our systems. We go into the room, and the two guys who are the technology guys is the guy who plugs in the network cables and the guy who installs Microsoft Outlook on your PC. Those were the two guys that were called technology guys, and they both fell asleep during the meeting. They both, by the way, flew to the meeting from somewhere else in the US, like gigantic waste of money and time. So that wasn't so surprising, that these vendors were not going to be particularly technology-oriented, and we generally can overcome those issues by just telling them, okay, just drop stuff on secure FTP servers, or whatever, or give us a raw data feed, we'll sort it out ourselves, and so on. But the second piece to me was surprising, that healthcare vendors don't live in environments where they get beaten down on their error rates. Healthcare tends to have a really 10 to 15% error rates, where claims are wrongly coded, where transmissions get dropped, and so on, in ways that are very core to the way the business works. And nobody seems to really care all that much because, again, you and I, as the end users of this thing, are not the end customers. We don't make decisions. We get pissed off. We call a broker, we call an insurance company, complain about this stuff. But because of the complaining, an HR department's not going to drop Aetna United or whatever for the 40,000 members that they have. And so that's why we, in essence, then said, we got to be full stack. We got to do everything ourselves. And we got to rebuild the systems from the ground up so that we now have our own claim system. We have our own processes around anything from utilization management to clinical research to RBC member services, even inside sales and so on. And you see the impact from that when one little data point, for example, not surprisingly, there you can make good decisions or not so great decisions when you select an insurance plan. And if you really want to feel stupid once in your life, and I'm sure people in this audience don't feel stupid all the time, all that much, because we're all pretty smart here, try to select an insurance plan. It makes you really feel like an idiot. Deductibles, co-pays and all these things, and these giant tables and everything. But there is an economically optimal choice you can make if you sort of know what your projected utilization will be, okay? When we look at who ends up in the optimally economical choice among our members selecting insurance plans, when they call our team, our sales team of people on the phone, when you buy an insurance from Oscar, we make better decisions for them than if you go through brokers, which is sort of hilarious because brokers get paid shit tons of money for making decisions on your behalf and don't end up making particularly smart decisions oftentimes. And so, long story short, this sort of like full stack approach, I think, is the way to go. It's the harder way to go for sure, but it is the way to go. And the trajectory looks a little bit more like this, but then it gets more exponential the farther you get out on the curve.
I think the other thing is talk about the size of the investment in technology. And it's just, how many of the smartest people you know said they want to go work for a big insurance company? Mario says this all the time, really not that many. How many of the smartest people you know in New York say they want to go work for Oscar? Quite a few. And that's to a large degree because of sort of the audacity of what he just said. It's just a ridiculously hard task. And talk a little bit about the talent that you've been able to attract.
Yeah, we're as it happens, we're the biggest alumni shop of Bridgewater Associates people, which is the smartest hedge fund in the world. I was there myself, which is why I can say it's the smartest hedge fund in the world. But no, very smart hedge funds, very systematic thinkers, look at the global economy, try to derive how you trade the markets based on really first principles again. And really in the founding story of Oscar is this sort of like insight that if there is one entity in US healthcare that sees the entirety of the data flowing through the system and also controls the money flow, it is the insurance company. So we really thought if you want to have really impacts using data and deeper insights on how the healthcare system overall works, you got to be the insurance company. And so as a result, lots of Bridgewater people, lots of other hedge fund people, lots of people from Facebook, Google, and so on coming over. Our CTO and SVP engineering is a guy named Alan Warren. He used to run the Google engineering team in New York. Came over a couple of months ago, actually. Joel Klein from School Chancellors on board, running policy and strategy. So really people who just want to do ground-up stuff that's important and has an impact, and not sort of like worry about getting your pizza delivered 10 seconds earlier, as what seems to be the goal with AI and messengers these days.
Now, in addition to your full stack approach, you decided to go direct to consumer from very early on, and the ACA created this moment in time where you could sell directly to individuals. But there are other verticals in insurance, auto, where that has been around for a long time. So why, I guess, healthcare, and why not try the model in a different vertical instead at first, at least?
Yeah, well, honestly, I could say we had a grand plan there. We looked at all the insurance companies and we decided this is the way to go. But that wasn't the case. It was my wife's pregnant. Damn it, this doesn't work. Let's do that. But I do think, in hindsight, it was a very lucky choice in a sense, because the big difference between any other insurance vertical and health is the number of interaction points you have. In auto insurance, in home insurance, in property and casualty and so on, you don't crash your car all the time. Your auto insurer does not pay, at least from what I know, for your car checkup. Every few months or so. There is no preventative care in cars, at least from what I know. You don't go there and somebody strokes the car or whatever, say run a little bit longer. But these are all interaction points we have in health. I mean, health insurance companies, health insurance, the way it's set up nowadays, is worrying about more than just when you get sick. We have preventive care built in, not just us, but every insurance company. We didn't invent this. We actually, in a very unique way, are economically very aligned with a member. If we can get you healthy or keep you healthy, we will make more money. And I honestly like that as a economic alignment. And we, the average member has 4 doctor visits a year, has 8 prescription drug refills a year, and so on. So you have these interaction points. And so that's a very important difference, because if we were in a situation where the only thing we could do is after the fact, after something bad happens to you, we then sometime later jump in, oftentimes 2 months later after the insurer hears about it.
And say no.
the only conversation we can have is saying no.
Yeah.
You know, it's really the only conversation you have, and that's why you don't generally like your insurance company all that much. We try to get out in front of it. We try to teach people from the very beginning. Oscar is your entry point to healthcare, whether you do it through the mobile application, through the website, through just calling us. It doesn't frankly matter, as long as we insert ourselves in the conversation and can keep you out of the traps that are laid out for you everywhere in healthcare.
This is like Mario's done an extraordinary job here. Like the only thing we hate more than our insurance company is our carrier, our cell phone carrier. Like if you look at the most the most hated industry, insurance is right there. And if you look at Oscar, everything is built to make us like Oscar. Now it's a difficult time in our life. We're sick, claims are difficult, et cetera, but it's call us, let us help you. Tell us, talk about like Telemus and talk about some of the things you've done to help us sort of find who we need to better, measuring outcomes so that we go to the right providers.
Right.
Etc. Like really,
right, I mean, just a few. What's different actually in the experience we have? It's not one algorithmic deep insight. It's a lot of various reinventions in the way that you experience healthcare. For example, we became the first insurer really across the country that says, let's make televisits totally free. So you push a button and the physician will call you back, and that never costs you anything. It's 24/7. About a third of those phone calls happen outside of office hours, where the only alternative you would have had is to either sweat it out. Or tell your 3-year-old kids to sweat it out, which is hard to do, or go to the ER, and now you can push a button, doctor will call you back. Why do we do this? Well, because it does reduce ER utilization. And we also, when the physician on the phone then takes notes on what is wrong with you, scan those notes and look for certain keywords that indicates that you may have some other things going on with you. One of the things we launched just a couple of weeks ago, a very simple thing, and didn't really take us longer than a month or so to implement, is when you hang up the phone after one of those televisit phone calls and the doctor mentioned to you urgent care, ER, something along those lines, we send a fax. Healthcare is a hilarious retro future kind of thing, like in Back to the Future Part 2, the movie where he's in the future. I remember that everything was a fax machine. It's sort of like healthcare nowadays. So we send actually a fax to the physician that we've detected as having been the most involved in your care, which we know because we have all your claims, right? And the fax simply says, one-page fax, it says, Mario is about to go to the ER, call this number, or urgent care, whatever, call this number, type in this PIN, and then my cell phone will ring, because we have your phone, obviously, you're our member. When we detect that phone call, because to run through our systems, we pay the doctor $25. Very simple thing, very straightforward. But physicians like it because they don't get paid for phone calls typically, and they don't usually have this real-time handler on when you go to the ER. Doctors do not know when you went to the ER. They just don't unless you tell them that you went a while later. And so that's a kind of a unique thing. We have our own team of nurses internally that reaches out proactively if we see you doing certain things on the website and not being able to find a physician. We do a lot of work on algorithmic physician discovery. I think we're the only insurer that shows you physicians that you can go to. What do they over-index on patients that look like you? So if I want to see a pulmonologist, I'd like to probably see a guy who sees a lot of patients in their 30s. I'm 37, so ideally he over-indexes on those kind of guys, and so we can show you that. We can route you there. We make those appointments for you. Again, we try to be the entry points and encapsulate the whole thing. It's still very, very hard. There's no question. We still have to say no sometimes. It is an industry where, in particular with high deductible plans, which is just the new reality of healthcare going forward, that deductibles are a thing of reality. It is still very easy to have a surprise in the healthcare system we want to keep you out of. But as Joel was saying, about a third of our membership now comes to word of mouth. We seem to be doing something right.
Mm-hmm. On that note, I think any of us who've ridden the subway in New York City have probably seen one of the Oscar ads down there. Talk about word of mouth versus some of the other marketing channels you use, how those have changed over the years, and where you're seeing most effectiveness today.
Yeah, the subway ads are kind of a funny story. I actually think, not to claim too many firsts here, but I actually think we were kind of the first technology company putting subway ads. Now it's a bit more. But why do we do this? It's with a bit of an odd choice.
Just by the way, notice he defines the company as a technology company, not an insurance company.
That's exactly. I mean, that's why. And usually you don't have that. You don't do subway ads. Dr. Zizmore popping your pimples does subway ads. But it wasn't really sort of tech companies in a sense. But this was the very simple insight. We started running search ads, the usual whatever, search engine optimization and banner ads and so on. We just noticed we didn't get members out of it. We didn't get members out of it very early on in kind of late 2013 when we first opened our gates in the first open enrollment period for the first Obamacare year. And we kind of looked into it and asked some people, and it just turns out that people didn't know us. In buying something as heavy as insurance, you kind of do want to have an idea of what this company is you're about to buy insurance from. And so that's what we thought, is there a way to make us look more solid? Dr. Sismo is the wrong example, but there are also banks and whatever else in the subways, and so we thought, let's put some out-of-home ads, and that made a huge difference. Subway ads, consistently, when we ask members, are the second biggest channel that people describe as this is the reason why I joined Oscar in New York. The biggest is word of mouth. It's 35%. We then took this, by the way, to other markets, Los Angeles.
How many people ever chose their healthcare insurance company because of word of mouth? No, seriously, this is really different. This is upside down.
Yeah, because it wasn't possible before. Literally, nobody probably here ever bought insurance because you all have good employers. So, but we took it to other markets as well, out of home, and it doesn't work there. Like, it never worked in Los Angeles, never worked. We had a bunch of billboards in New Jersey. That stuff never worked. So
what works out there?
Sorry?
What works out there?
Radio works better. Radio, in particular, these sort of like DJ reads where the DJ talks a bit more about the story. Because again, you need an authority figure. In New York, the subway is very egalitarian. Hedge fund managers and people building your furniture or whatever alike ride the subway, and radio might be a bit more like that in other places. Anyhow, it's never over. We have we try to sort of like. Always straddle this line between creating awareness for the fact that we're a new kind of insurance company, but also still coming across as solid. One of our most ever tweeted and whatever ads was a guy pulling his pants up and taking a picture down his pants, basically saying, "Talk to a doctor anytime you want." Was a big hit, but it doesn't necessarily create sort of like a solidity of that you sometimes want an insurance company. But then you got to follow it up with immediately a good conversation when people actually call you. And that is then usually when we kind of hammer it home, when you have a guy on the phone who knows how to talk about Oscar plans, and it's not a call center somewhere else outsourced, but really in-house.
Joel, in terms of other fintech businesses, do you have general advice that you give portfolio companies in terms of customer acquisition? I know it's a little bit different in insurance, given the ACA kind of created this pool that was available for the first time, but that it's where a lot of folks are spending a lot of their dollars. And
I try never to give portfolio companies too much advice.
Okay.
When I'm giving them advice, it's going in the wrong direction. Like, they're the ones supposed to be the expert in everything. So that's just a general belief I have about venture. It's that my job is to pick people like Mario and then enable them, and to try to provide advice, not to hit the rails, but generally speaking. I think with regard to I think there's just a transparency that's required to sell in the consumer space today. There's an honesty. If you look at the insurance business at large, and like Mario suggested, outside of health, one of the problems is the lack of frequency of interaction. And you look at how you buy indemnity insurance, it's really opaque. There are no, like Check24 or something in Germany, but there aren't very many comparison sort of transparency tools in the United States. Everything is designed by like knuckle dragging insurance companies that sort of want to keep everything a little bit gray, and so on and so forth. So I think today in any consumer space, particularly if you're selling to sort of younger consumers, use of technology, just full transparency, just put it out there, tell everybody what you're doing. In the insurance business, we also overinsure. Consumers probably overinsure. I don't think that consumers should ever buy more insurance. You should only insure up to the point that you can't afford to pay for the loss. And I think that that's one of the problems with this sort of lack of, there's no normal dialogue. If you're sold by a broker, you're heavily sold. The broker's heavily incented, there's enormous marketing behind it that sort of creates this air cover. And if you're sold direct, you can't figure out what the hell you're buying. So I think in general today, in the consumer space, transparency, lack of opacity is required. In the insurance space, because I do think there are a lot of people that are interested in what are the other categories of insurance that are sort of VC backable. And I think there are a lot. But I think a modern company has to start with, I'm going to put it out there. I'm going to tell everybody exactly what I'm doing. I'm going to make my pricing really clear. I'm going to make my benefits really clear. I'm going to make it easy to talk to me, and so on and so forth. Does that answer your question? Or was I?
No, I think so.
Okay.
But you mentioned insurance companies that are VC backable. I think in general, the space is way more capital intensive than a lot of other consumer tech companies.
Good.
Mario, how
That's a good thing. Like, because if you're the best at it, and if you're the first out of the chute and you're the best at it, and you actually find a fair contract with consumers, it makes it really hard for people to copy you. If you're delivering pizzas 10 seconds shorter than the other, to use Mario's sort of pejorative comparison, it's not that hard to copy you. If you've got a reasonably difficult industry to enter, there's regulatory barriers which are difficult to understand, there's capital requirements that seem pretty steep, and you get good at it, and you find a contract with consumers that's based on trust and transparency, it's hard to compete with you. That's a good thing. I like that.
So the moat is pretty thick once you reach that kind of scale. But I guess talk a little bit about how much time I guess you see yourself, or you thought you would spend raising capital versus how much time you actually spend today, and how much of that how much energy is required on that side of the house.
For raising capital?
Yeah.
It's as you were saying, it's a very capital-intensive business. I mean, there's no question. And to some degree, also, we as a company were a startup within a startup. The ACA itself is a startup that only over the years is getting better and better understood. ACA, again, Affordable Care Acts, right? When you look at some of the big insurance carriers selling in the individual markets, and you sort of look at how did some of the government programs affect them, federal reinsurance, federal risk adjustments, risk corridors, and all these things, you've had very, very big swings on a percentage basis in their P&L for all the financials over the last couple of years. And so we have to be able to withstand some of the same swings until the market has oscillated itself to a point where it is stable. Normal time, a couple of years to go through for any new insurance market launching was the same in Medicare Part D, Medicare Advantage, kind of when Medicaid started getting privatized and so on increasingly. But you have to be able to withstand that. And so we had to raise a good amount of capital. I do not like spending time on it. I mean, there's no question. We like spending time on obviously great conversations like this one, but also mostly really building the business, And I absolutely, I shouldn't say I hate it, but I really don't think it's time invested in trying to build the company if you have to go out and talk to investors all the time. No offense, Joel. But we were fortunate and also have a fantastic fundraiser on our team, Josh Kushner, that we were able to. We were the first out of the gates in this. Still one of almost the only one out of the gates. There still really isn't any insurance company that's technology-driven, selling in the individual market across the country. Still doesn't exist. That's active, actually. There's some people raising money, but not that's active. And so that led to a good amount of fundraising. We raised in total now about $720 million or so in the last 4 years. The vast majority of which is still on the balance sheet, over $600 million on the balance sheet still. And that's certainly a good thing. But it's also a very high top-line business, of course. So I think over the next 2 years or so, we should get from a position where we still fund the business to venture capital to a point where it actually carries itself.
So Mario, why do large insurance carriers, why is everybody else running away from the individual market, and we've got capital, time, energy, physics running towards it?
Yeah. So I don't think everybody.
My job here.
Sorry, Peter, you got better questions than Joel. Let me know. I don't think everybody is running away. There are some people making very good business. For example, the Medicaid plans that are used to more hands-on medical management, that are used to actually working with individuals in different income levels, but conceptually sort of like a similar business. They have actually had very good results for the past couple of years. It's not a story I hear people talk about all the time, but the big insurance carriers, they have been sort of complaining about this. But again, why is it the case? Well, because this is not their markets. If you look at the P&L of the big insurance carriers, they aren't even in the business of taking risk on healthcare anymore. They're in the business of running the so-called TPA business, third-party administrator business. They go to self-insured companies, they pay the claims, they get paid a management fee for that, and that's the end of it. And so if you're in that business, the shift you have, the incentives you have is, get people off the phone. Don't get them to ever call you. The incentive you have is satisfy the HR departments. The incentive you have is build the biggest network possible, so that nobody in the company complains. And the incentive eventually also is not really all that much around managing your costs down. If you think about a business where 85% of your costs, so-called medical loss ratio, expands at a constant rate of between 6 and 10% every year. That's healthcare inflation in this country over the past 30 years or so, right? And all you do is you mark this up by a constant 15%. That's an awesome business. I mean, I actually don't want to be in that business. We are in that business in a sense, but I would like to not be in that business, because if we keep being in that business, all of us together, by 2050, I just did the math recently, half of our GDP will go to healthcare. That cannot be a good idea. And so to your question, Joel, some of the big carriers are running away from it because they realize they got to shift from a business where it's all about HR departments, all about sort of like not managing costs all that closely, towards pitching to individuals, having people walk out on you potentially in this new business where people can vote with their feet, and they don't like that all that much. I think much of what's been made of the financial results in the markets is, in my opinion, overblown, because again, in every other launch of other insurance markets, that has been the case. It's difficult to launch these markets for insurers to price right. Give you one statistic: if you look at the Congressional Budget Office projections for where individual market premiums they thought were going to be in 2016, they thought back in 2012 where they're going to be, we are still 16% below that. Collectively, the individual market probably lost about that much on a medical loss ratio basis, which means, lo and behold, a new market where there's competition, people underpriced a little, and now we're going to have to come up a little bit, and then it's going to be a good business.
Can I ask him one more question for you?
No.
Oh, come on, it's a good one.
Okay. Better be good.
It's reasonable. It can't be that good. But so part of building a successful business was sort of looking at this from the consumer. Part of this was building a technology stack that was differentiated to support that consumer sort of centric look. The other part of it is defining a product and creating a product that we can afford to deliver. And the breadth of product that we can afford to deliver and be highly competitive. You want to talk about that a little bit?
Yeah.
Sort of the integration with the provider network and the
Right.
technology it takes to do all that too.
Very important points. If you look at the way we rolled out in all of the cities we've been in since the very early days, we always basically said we're only going to. This is the solution of the San Antonio riddle, in essence. We said we only can go into cities where we can build a unique relationship with a provider system. If we go into this sort of like business of just getting everybody in the network, then you are building a system where there is no correlation between quality and costs. If you look at healthcare nowadays, we did that math almost since the beginning on all kinds of our own claims data. There's academic research on the same question. There is no correlation between quality and cost in healthcare. This approximation, when you buy a good wine, must be expensive, must be good, or whatever else, or buy a good car, must be expensive, must be good, does not hold in healthcare. If you have a guy who puts a sign on Park Avenue, cancels all his insurance contracts, everybody kind of thinks, oh, that guy must be great. He doesn't take insurance, must be a great guy. Not the case, just not the case. Be very careful about this. What the future of healthcare delivery is, in my opinion, is an unbundling of the system where you can really go to the highest quality providers for particular issues you have, and where then someone like us can orchestrate the experience across the boards. And that's what we basically do. When we went to San Antonio, we made a big deal with a hospital called Tenet, for example. They own the so-called Baptist system there, system of hospitals and physicians. And we said, let's tap into your systems. Let's make sure we have more data about your physicians than any other insurance company has. Let's make sure we can route more quickly to your physicians. Let's make sure we can make appointments there more quickly. As a result, you get a better experience for a lower price because we sort of like tighten these relationships more and give a better product experience. Healthcare is the only industry, I think, where you can actually say without blushing, you could get a lower price product at a better quality, because the US is such an insane outlier in terms of what we spend on healthcare collectively. Switzerland, Germany, Japan, 10, 11% of GDP goes to healthcare, and they have good healthcare systems, I can tell you that, from Germany. US, 18% of healthcare of GDP goes to healthcare. The only rich country in the world where you have such a big gap. That needs to come out of the system, and these more concentrated, curated networks is really an important part of the whole of the puzzle there, in a very important way.
And the contract with the consumer is, you explain exactly what that is. It's
exactly
straightforward.
Exactly, yeah. We get you in with lower wait times than you otherwise would get. Providence in Los Angeles, the other system we did this with, and you're going to see us doing this in other places as well. Very important part of the overall story.
Okay, I'm sure there might be some questions in the audience. Maybe give me and Joel a break from moderating here with Mario. And on those coming?
Yeah, we have questions here. Do you think the ACA is working, and is there any worry that if Trump becomes president, that Oscar's business might take a hit should they impede or repeal the ACA?
Yeah, it's always a great question. So I think the ACA is absolutely working. I think if you look at the positives, okay, if in 10 years from now, 15 years from now, we haven't shifted healthcare and health insurance towards individuals making decisions, I honestly think we're screwed as a country. I really think we are. The US is the only one where, through weird historical legacy, World War II, freezing of salaries and so on, employers got into the business of deciding on your benefits, basically. If you compare this to defined benefits, pensions shifting to defined contribution over the past 40 years or so, the same will have to happen in health insurance and healthcare. It will have to get individualized. The ACA is our biggest foot in the door of that happening. And I actually think that the fact that insurance companies all collectively underpriced in this market, which explains the sort of shaky medical loss ratios you've seen across the country, is a sign that for the first time when you have to lay bare your pricing, holy crap, they price competitively. You know, they couldn't get away with pricing all over the place, as you sort of like have if you kind of pitch an HR department in a sense, you know. So I think those aspects of the ACA are working. Insurers, you know, all have to come out, do more direct marketing, build more of a brand directly, worry more about their customer service, and we see this. I mean, in every market we are competing, you see the other insurers waking up and saying, "Oh yeah, I should redesign my websites." You know, as long as they're only doing that, I think I'm fine for a while. But those are very good aspects of the ACA. Certainly, the medical loss ratios have to become more sustainable, and the pricings become more sustainable. That will happen, in my opinion. The risk pools will stabilize. If anybody becomes president, I think, in my opinion, economic sanity will win out over time. You can't turn back the clock on 12.7 million now newly insured Americans. That will never happen, whatever who becomes president. And even Trump has indicated already that he doesn't want to let people die on the streets. And so one way or the other, whether through tax credits or through subsidies as we have it now, or through other means, I think this market will continue to be the case. If you look at healthcare inflation over the past few years, it's been much lower than has been before. Whether you can fully put this on the ACA, I don't know. But there must be some correlation there for sure. So long story short, yes, it's a good idea and it'll survive.
Yeah, leaving aside politics, the act is a few years old. It's epic in its sort of impact on the healthcare industry. And this is 3 years in the beginning of a long experiment.
There's stuff that's got to get fixed. I mean, we, right now, this is a thing called special enrollments. You essentially can wait until you're sick and then buy insurance. If you write yourself a letter that Mario Schlosser Incorporated just dropped my own health insurance. You know, it's like a weird sort of like loophole you can create, and that honestly has to stop. We have to make sure people understand that they have to enroll in open enrollments, whether they're sick or not. Otherwise, you can take advantage of the system and the money we're all paying into it. That's the way insurance works. But CMS and HHS and so on, they are on top of these things, and these kinks will get worked out.
You talk a lot about the carriers. What role do you think providers play in the problem of healthcare costs, and what have your experiences been with some of the larger provider systems?
They play a huge role. I mean, the reason why we have 6 to 10% healthcare cost inflation, not because the insurance companies. I mean, they make 2-3% margins and price maybe again 10-15% on top of the healthcare costs. It is provider pricing. That's the reason why costs have gone up so much over the past couple of years. When we interact with them, and again, as Joel prompted me to say, they play a hugely important role in the way we think about the world. I see a huge bifurcation there, and I don't know if it's 50-50 or what the split is, but there are some hospital CEOs that basically want to ride the fee-for-service gravy train all the way against the wall. And whether the wall will be antitrust or regulation or consumers voting with their feet because they have enough of these healthcare cost inflations, I don't know. But that wall is going to be there. But they want to milk this thing for all its guts. And there's another class of hospital CEOs that basically says, I want to be at risk for the healthcare I deliver. Almost nobody's at risk in this country on the provider side. Like it's all mostly fee for service, right? You get paid for every service you deliver, and that's where you get the $35 aspirin and all these things that people have written about. So this class of the hospital CEOs, these are the guys we want to work with and we consistently work with. They are the ones who say, Oscar, put me at risk in this. Let me tap into your premium flow so I can keep my ER empty and actually get paid for that. Now I get paid for an empty bed as opposed to only for filling a bed. That's fantastic. Member loves it. Provider loves it. Oscar loves it, right? And that class of CEOs basically is the one we're building with, in San Antonio and Dallas and in LA and increasingly also wherever else we go.
But talk about what needs to be done with the information stack in order to get there too.
Yeah, you can't just sort of like say, oh, I only work with one hospital network. What I hear, healthcare is one of these hilarious places where people really think in glacial time periods. When we have that conversation with providers, the big pushback we sometimes get is like, oh yeah, we tried this in the mid-90s with HMOs and people didn't like it. Like mid-90s, that's when Apple launched the Newton. So since then they actually have built a tablet that you want to use, So, but that's sort of like this thing, like 25 years ago it didn't work. Yeah, it didn't work for good reasons, because you made a deal with only one provider network, and then you didn't tell anybody of your members where they can go. And they had to wait much longer to see a physician. They had to go to a PCP with 6 years wait time, 6 weeks wait time to then see the dermatologist and all that crap. So that doesn't work. But if you go and build a more deeply integrated product where you literally tell the provider networks, hey, give me some appointment slots that Oscar can use to just schedule appointments very quickly. Let me use your nurses to answer phone calls, or your doctors to answer phone calls, the stuff we actually try to build with these provider systems, then you can make it work very nicely. When we talk to members on the phone, way more than them saying, I want to go to this exact doctor because I have a very good scientific reason. They say, I need a colonoscopy, I need my child is sick with this, I had this literally a couple of weeks ago, my son's had his tonsils taken out. Who do I go to? I want somebody to answer these questions using good data, using good narrative, and we can do that for you if we work more deeply with the network. So play a big role.
Let's go over there.
Great. This will be the last question.
Awesome.
You've talked a little bit about Oscar's plan to grow into 30 markets, but given the sort of lower than expected turnout in California, what is the plan going forward, and why do you think the turnout was lower than markets like New York?
Yeah, so what you mean is in California we had about 5,000 members, in Los Angeles and Orange County, and that's out of the 135,000 members, not the majority, even though California is big. That was a bit below expectations. We sort of thought we can get maybe to 10,000 so in the first year there. It came mostly from, I think, two things. One is pricing. It's always difficult to get the pricing right when you go into new markets. And it is just the case that the monthly premium we charge is a big sort of like signal people look at and say, can I afford this, or somebody else much cheaper than we are? So we came a little bit too high in price, and that will continue to be I expect that to be the case when we go into new markets. We will sometimes come in too low, sometimes come in too high. It is difficult to understand exactly where the medical risk and utilization will be in a new market. I can give you some preview for Orange County next year. We're going to come down in price, for example, because we now know better where our risk is in that market, where the reimbursement rates are and so on. The second reason was that we start actually advertising way too late. We do have to get out there and tell people the story that what they're buying with us isn't traditional insurance coverage. It is that and an orchestration of healthcare for you. Call us as the entry point to your healthcare system. We will do a lot of the work for you that you either have to do yourself through stacks of papers and faxing, or that somebody like us can do for you. And getting that narrative out is not an overnight thing. Getting the narrative to actually the partners we do sell with, we do work with a select number of brokers as well who can tell the story well and so on, takes some time. And so in a place like California, if we come in with a low membership in the first year, I really don't sweat it at all. When the word of mouth starts kicking in, that number will go up. Whether it takes a year or more is of no concern to me. In New Jersey, we were at 2,000 members in the first year in 2015 and went to 30,000 the second year. So as long as we repeat kind of like that steady growth of market share, we're totally, I'm very, very happy. And frankly, we don't want to grow too quickly either, because this is an insanely complicated industry and business where you really want to make sure you get your systems totally right and your data totally right before you start offering plans.
Okay, and like that, we are out of time. So I want to thank Mario, I want to thank my co-moderator Joel, and I want to thank all of you for sticking around at the end of the day. Thanks.